All right, next, let's talk about some policy loan differences. All right, this is important. This is where there's actually, I would say, a little bit more flexibility with this within IUL for retirement income, not for the infinite banking concept. Guys, just don't try to do infinite banking with IUL. Oh my gosh, it's not designed for infinite banking. Okay, I've done an entire video on this as well. All right, infinite banking is where you set these policies up. You're borrowing against the cash value to go build wealth over here, right? So we've got money working for us in multiple places. It does not work well at all with IUL. Just keep that in mind. With that said, when you hit retirement, right? So one of the big promises of IUL is that all of this tax-free retirement income that you're going to get. Okay, well, assuming that your policy performs and you've done things correctly, let's say you get to that point where you're hitting retirement, you're ready to start taking income from it. All right. The problem is most agents, most illustrations I've seen show the participating loan for the retirement income, not the wash loan. So there's two primary types of loans with an IUL. There might be others, but these are the two main ones. It's participating and wash loans. All right. Let's cover wash loans first because they're pretty simple. Indexing is a little bit more complicated. It's not complicated, but there's more involved. With wash loans, there's no risk of that loan, the interest compounding against you. So it's a lot safer. It's a much safer way to take income and just take money from the policy. All right. Because basically what's going to happen is the life insurance company will charge you a certain amount of interest, maybe 3%, whatever, but then it's going to immediately credit you 3% interest. So it's a wash, right? So your interest is not compounding against you. That's a much safer way to do it. The problem is most agents don't illustrate that because it doesn't look anywhere near as good on paper, which brings me to the participating loan. So a lot of problems with the participating loan inside of an IUL for tax-free retirement income. And also, actually, one other thing I want to say about the wash loan, the reason you can't use that for infinite banking is because I've heard people say that you can do infinite banking by taking the wash loan, but you can't do that, or it defeats the purpose of infinite banking anyways. Because here's the thing is because it's a wash loan, that means the money that you're borrowing is no longer earning interest. All right. So if you have a big year in your IUL, but you have this wash loan taken out, the amount of money you have for the wash loan does not participate in that interest growth. All right. So it interrupts the growth of the policy. That's not infinite banking. All right. So that's another part of the wash loan that you want to be aware of versus participating. All right. So basically what that means is all the money that you borrow from within when you're using participating loans, it's still going to earn interest within the policy. All right. If your IUL grows. Okay. So that can be a benefit. The downside to that is that you are accruing interest. And if you're not paying that policy loan down, that interest is going to compound against you. Now, this is really important, guys. I'm kind of jumping ahead a little bit because I want to talk specifically about the illustrations here. But since we're on the topic of the loans, when you see on an IUL illustration, when it's showing you taking out income, all right, a lot of the times it shows the participating loan and it shows the policy growing every single year as if you never have a down year, which is never, ever, ever going to happen. And it also has 50 basis points of positive arbitrage within that loan. So it's kind of like when you take the loan, you're making money, you're like above and beyond what you're paying in interest. So the policy is going to continue to grow every single year. Never going to happen. Market doesn't go up every single year, guys. So that's very dangerous because that interest is going to compound against you. Okay. So let's say you're 5, 6, 7 years into taking money from the policy. Let's say you've been taking $50,000 per year and you now have 5, 7 years later, you have a $250,000, $350,000 loan balance at 5% interest. Actually, it'd be more than that because the interest is compounding against you. But if you have a 0 year, which is going to happen, where does the interest cost come from on a $300,000 loan? Where does that interest come from if you get a 0 year? It comes from your cash value, guys. That's why the illustrations with these things can be so incredibly misleading. You have to be so careful who you work with. I've only seen and spoken to a couple of agents that do it the right way. They put zeros in to make it more realistic. They show withdrawal up to basis and then wash loans. Like that is how you're supposed to do it. But it doesn't look anywhere near as good on paper. So a lot of people probably wouldn't do it if they showed the wash loan and doing that strategy. So just be very, very careful with the participating loan, guys. That's typically what's illustrated at the end of the policy when you're taking retirement income, because it looks really good on paper, but that interest is compounding against you. When you get a 0 year, that can be devastating to your policy, depending on what year you're at and how much you've taken. All right, policy loans with whole life insurance. It's pretty simple. I mean, it's just you're taking a policy loan, that interest will compound against you if you are not paying that policy loan back. Typically, we're doing that with the infinite banking strategy, where you're going to be paying the loan back. That's why if you're not disciplined with money, infinite banking is absolutely not for you. But typically, you're going to be paying that policy loan back, so it's not an issue until you get to retirement. So if you're going to use your policy for retirement income, again, I'm not a fan of stacking really big loans and like aggressively taking income from the policy, guys. Just be very careful with that because that interest is going to compound against you. Now, the difference is that a whole life policy is guaranteed to grow every single year. You're not going to get that 0 year. That would be just devastating to your policy. And also, if you fund your whole life policy properly, you let it grow for long enough, it's pretty efficient. Whole life policies get more and more efficient every single year. Then it's not as big of a problem, but you have to make sure you're not over leveraging the policy and taking too much income via a policy loan, because that can get out of control if you take too much. But again, as long as you're working with the right agent, they illustrate it very, very conservatively. They illustrate it as a supplemental tax-free retirement income, then you should be okay. And I want to stress the supplemental part of that phrase, because I particularly see this with IUL, where IUL is supposed to be it's supposed to become the primary source of retirement income. I see a lot of agents talking about replacing your 401k with it. Like that is just insanity. Don't even know how that's legal. But anyways, it becomes the primary source of retirement income. It was never meant to be that, guys. All right. It just doesn't work for that. It's a supplemental retirement source of income. It can make your other assets perform even better and last longer in retirement, because they can be a volatility buffer as well. There's just like so many benefits to having whole life insurance, permanent life insurance in retirement. But it's just important to understand the differences here. Okay. This is supplemental retirement income. So with that said, what you could also do, what I'm a bigger fan of when using whole life insurance for retirement income, is don't do the policy loans, at least until you have to. You can do a withdrawal up to your basis, which means all that's tax-free until you reach however much you put in. Okay. You could also turn your dividend into paid in cash. And is that going to be a ton of money? Is it going to look as good on paper as it does in IUL? No. But if we're being realistic about this and acknowledging that this is just a supplemental retirement income stream, and I could take more if I needed to during a down year in the market where my portfolio just took a big hit. Maybe I don't want to take money from my portfolio for the next couple of years. I'm going to give the market time to recover. So I'm going to take a little bit more from my whole life policy, while it recovers, and then resume taking money from my portfolio. To me, that's how it's really supposed to be done. So just a couple of different things to think about. But as far as the policy loan with a whole life policy, it's pretty standard. You're going to, you borrow from your policy based on how much cash value you have. And then there's going to be a certain interest rate on it. And if you don't pay that policy loan back, it will compound against you. Otherwise, it's simple interest. It can be really, really powerful. I've done other videos on that, but those are the main differences. Hopefully that helps.
What's up, my fellow wealth creator? Thank you so much for checking out this clip from the Millennial Wealth Creator Podcast. If you'd like to watch the full podcast, there will be a link down below in the description. Make sure to also check out the additional tools, training, resources that I have in the description as well, just to help you along your journey. Thanks again for checking out the clip, and we'll see you in the next one.